Hey there everybody, thanks a lot for joining me as at this Monday afternoon market recap. Today's date is the 4th of March. Over the past couple of weeks, we've been really just following this market as it has continued to drift on up higher. We've been waiting for that of an outside day candlestick to develop, and essentially today that is what we have just printed. Pay attention to the Dow Jones Industrial Average. The reason I haven't been all that loud, all right, so to speak, in this public forum here on YouTube is again because we've been waiting for a signal. The markets themselves, they have been in a rather delicate type of location across the board respectively on the charts. Let me just show you this. Really, since breaking out above 25,547 over here, we've been looking for this upper resistance area on the Dow to be triggered or actually to be hit. Now that's coming in at 26,507. It wasn't until really the 25th over here of February where we started to see that first reversal candlestick. And really since the 25th, we have more or less moved sideways. In fact, today, on the Dow Jones Industrial Average, intra-session, we did push to 3-week lows. So a lot of what we have been speaking about over the past month or so, whereby the market itself is continuing to drift, albeit as we continue to move further and further into overbought territory and sort of overextended territory, a lot of this can unravel relatively quickly. And I think today, as at the close on Monday, we're starting to see just how quickly the market can, of course, revert, or at least reverse in its current directional move. Now, I just wanted to say from the outset of this recording, we are still macro bullish on the overall markets. We are still also on the intermediate time frame, still looking at these markets in probably the first half of 2019, breaking out above those September and October 2018 highs, then continuing to trend further on into 2019. So nothing has changed there whatsoever. However, what we have been really referencing and speaking about, or at least forecasting, is, well, are we going to see this pullback most likely back into the rising 50 exponential moving average? We may even overshoot this, but as it stands, on the Dow Jones Industrial Average, although we only closed down 206 points, it was, relatively speaking, quite a distance off from the lows. We did see a little bit of a bid re-enter into the market towards the back end of this session, but really a logical target for a number of reasons, not only for the 50 exponential moving average, but earlier, or at least in the late portion of January, where we started to build this as resistance. Again, sort of interact with this as new support in the early stages of February. This area down here around 25,000 on the Dow Jones Industrial Average makes a lot of sense. Now, again, we can overshoot this if we do see, of course, a little bit more of a sell side volume into the market. However, I just wanted to point out that overall, depending on this and how deep it moves, we are still wanting to be looking to buy this market at a later date. Now, if I quickly zoom on in, or at least show you what we're looking at, these, of course, are the oscillators. You can see just how overbought we have been. It's really sort of pushing on about 1.5 months. Technically speaking, today we have started to see that MACD, of course, begin to trigger that of a sell signal. The RSI is adjusting out of overbought territory, and we already are very close to that neutral point on the 50 line. So again, pay attention to the RSI in conjunction with the stochastics. Generally, during that of a bullish continuation, you will see these two oscillators, these indicators, firmly hold that 50 point. The RSI can, of course, overshoot this temporarily, but more so in particular, the stochastics should stop. It should stagnate around this 50 line and then begin to turn up. This is going to be a work in progress. Okay, it's not something that's going to set up and play out as at Tuesday, but just be prepared, all right, for the market, if it chooses to do so, to continue to pull on back down to lower areas. Now, again, we've been speaking about this in regard to this bullish pop that we have seen for the first really 2 months, really since the back end of December. And what we've been referencing is the ADX. The ADX generally resets back down to the 20 line in combination with the retest of that rising 50 before turning up, which will establish the legitimacy of the continuation higher, ultimately to break above those 2018 all-time highs. So the commodity channel index, the CCI over here, it's still holding up relatively well. It's getting a print at 93, but we cannot really sort of rely on that indicator or place too much emphasis on that one indicator alone until we start to definitively break above the swing peaks on the all-time highs. And when you think about it, again, we've been in that of a long-term consolidation. When you zoom on out and see this, this is a pressure cooker, essentially what's happening and what has been happening over the past year or so. Once we break above these levels, it's going to be a mad rush into the market from people who, unfortunately, may not have entered during the correction back into the primary intermediate trend line. So at the moment, we're still technically stuck between support and resistance if you were to consider this being a rectangle or a sideways moving consolidation. This is still very positive for the market, and as long as we remain above this primary bullish trend line and of course the swing low back in December, this market is still technically healthy. Right, we haven't done any major technical damage. However, there is a possibility that we may set something like that up towards the back end of 2019. Now, I just wanted to show you something also. The Dow Jones Industrial Average, I just showed you. It's an outside day candlestick. It's not textbook because we do have that lower wick. When I go into the S&P 500 and also the NASDAQ, what we have on these markets are more so hangman at resistance. The interesting thing is, however, is that we're still not at our upper targets. I've still got 2,865 on my screen. Yes, I understand that this is the fourth retest of roughly that 2,800 area on the S&P 500. Let me just show you the area I'm referencing right now. You can see these three little peaks over here. This is the fourth right now. But this candlestick here, given the bounce off from the intra-session lows, it is still technically not all that much of a bearish candlestick because we're not technically speaking at the right location. Right? I do think that this is more so of an important resistance area above 2,800. Yes, we closed below it. We closed at 2,792. But the candlestick here is still somewhat forming in that of potentially a little bit of a stair-step continuation pattern. So if we do see a continuation to the upside, if a lot of these losses are more so made back during tomorrow's session or even Wednesday's session, be prepared for the S&P to rally on up to this area before coming back down and potentially retesting that rising 50-day exponential moving average closer to 2,700. Again, we're allowing this ADX to reset. It's a little bit closer. It's down at 27 and the CCI is at 103. So things are looking good. I should say on the trending side, however, we still need this market to have a little bit of a breather after some of these mammoth gains that we have seen off from the primary bullish trend line down here at roughly 2,400 on the S&P 500. We're still firmly holding above the simple moving averages. And when I bring you into this chart again of these exponentials, you can see that we're still technically holding up above the 10. The Dow Jones actually tagged that rising 20 today, and that's where a lot of the buying pressure came from. But generally, we will see this area crack on a second or third retest, which will then generally move into that retest of that rising 50. Now, just to conclude this, very similar candlestick to the S&P 500 here on the NASDAQ. Another little bit of a hangman at a resistance peak. You can see these three peaks in the past. This is now the fourth retest of this area. It's coming in just over 7,500 on the NASDAQ. We are still above the exponential moving averages, but the same narrative applies to the NASDAQ as it does the S&P and the Dow. You can see just how overbought we are. Again, we're relatively overextended. The MACD is trying to cross down. We don't necessarily need to do that, but what will be most helpful at this time is when the ADX, if we do see a dark candlestick, another sort of bearish day, the ADX turns down and moves back towards that sort of 20 line, and then when it turns up, that will be the right signal or the indication that, again, we're beginning to move in the trend direction, which is still very much so firmly to the upside. Now, as we sort of conclude that of Monday, I just wanted to sort of summarize what we spoke about over the weekend in regard to two stocks. Now, those two stocks are Amazon and also Google, because we've come to the realization that we're not in the best sort of trade entry location, so to speak, on the equity indices. And really the directional movement of the indices, especially relative, of course, to the NASDAQ, is what is going to be the outcome of both Amazon and also Google. Because Amazon and Google, and to a lesser extent Apple too, they are somewhat at breakout entries. And the reason I say that is because if I bring up the Bollinger Bands on Amazon, you can see here that we have moved into that of a Bollinger Band squeeze. We had our entry price here at 1,681. We've obviously broken above that area. We broke above 1,700 intra-session. We closed just shy of that. You can see 1,696 on my chart. And it's looking as though this may have a little bit of wiggle room. There might be a little bit of legs to this breakout, which is going to bode well, obviously, for the NASDAQ moving higher. So keep an eye on Amazon. If we see a long day white Morobozu candlestick in the price of Amazon, there's going to be a fair chance that the NASDAQ is going to lead the industrial average and the S&P 500 higher. If, however, we see tomorrow, or as early as tomorrow, that of a rejection of this area, then that's going to also play into the evidence which has really established itself today that the markets are firmly and finally moving into that correctional type of trading period that we've been calling for a number of weeks now. Now, if I show you the same sort of chart on Google, again, a similar type of trade setup, right? You do have a little bit of a Bollinger Band squeeze. It isn't as nicely pronounced as Amazon. In fact, the Bollinger Band squeeze on Amazon is a lot nicer than that of Google. We were speaking about this breakout on Google for differing reasons, but you can see we have more or less closed at that breakout entry, 1,156. We closed at 1,153. So what I will say, when it comes to Amazon and Google, tighten your stops, or at least have a definitive stop, because we don't, as at the close on Monday, have that definitive breakout yet. We've got this high wave spinning top on Google. which again, it's not necessarily a false signal yet, but you generally don't want to see or don't like to see these types of candlesticks show up, especially when you've got a pretty decent trade set up to the upside, but it is rather delicate based on what the market is doing too. And also to conclude with here, we've got Apple, which has been more or less moving sideways for an entire month. Very rare for Apple to do such a thing. And as such, the Bollinger Bands are squeezing. We have a similar candlestick as to what I just showed you on Google. It is a doji candlestick, all right? A doji candlestick. And this is coming after a bunch of sort of gravestone dojis. And this is also across the board too for the broader equity markets as well. If we bring up the Dow Jones, you can see we've got that shooting star, spinning top, another doji, sort of a nothing bearish candlestick, another doji, and then of course today we've got that outside day candlestick, the S&P 500, similar types of candles. If I go back a little bit further, you can see the hangman, the shooting star, a little spinning top, another sort of hangman at resistance, nothing sort of day, spinning top, and then a little bit of a hangman slash outside day candle today. Now also I just wanted to point out, when it comes to Boeing Airlines, you should be out of this trade as at today. You should have been stopped out this morning for some pretty decent profits. Now, whether or not you jumped in at 419.40, that was the definitive long entry. I know some people jumped in at lower prices at 414.50, which was good. Some also at 404.50. You did exceptionally well. We spoke about over the weekend placing your trigger, all right, or your stop at 440.19. That was the conditional stop entry on those original long trades. Now, we've obviously broken down below that today. We closed at 432. This trade has run its course, okay? And this is coinciding with that ADX as at today turning down. It really started last Friday. We spoke about this over the weekend with this bearish candlestick just here. And this is due to just simply how far we've moved and how far away we are from that rising 10 exponential moving average as well, or just sort of the velocity, the angle of ascent to these exponential moving averages. Now, glaringly, we've still got these open windows supporting price action below. It's going to be a big ask for Boeing Airlines to get all the way back down to 365, that general vicinity. But I have seen moves like this actually play out where, you know, currently at the moment, the current juncture, it seems as though it's almost an impossibility of something like that playing out. But I mean, anything is possible in the markets, all right? Now, again, you should be out of this stock. You should be sort of forgetting about Boeing Airlines. Allow it to sort of air, allow it to breathe. And more so what you should be thinking about is just following along with the equity markets, the broader equity markets. Again, adjust your stops, bring them up if you're still in other trades. But right now there is a little bit of uncertainty, so to speak, as to whether or not we are going to see this deeper correction. If we do not panic. Think about the move that we saw in the fourth quarter of 2018. As bearish as what the sentiment was down here, as dire as what things appeared, we have more or less made back all of those losses. And I'm not talking about personal losses here in trade sort of directions. In fact, we were actually looking to short the market up during this peak over here and during the establishment of the divergence and double top. You can see actually, historically speaking, the short entry on the Dow Jones Industrial Average. This was when the transportational average and also the Russell 2000 was breaking down and showing us divergences between the industrials and the transports, for instance, and also prior to the S&P and the NASDAQ, not to mention a few flaky sort of signals on the commodity channel index and also the ADX up and around this area. The sentiment at the top was exceptionally bullish. Everyone wanted a piece of the market as it continued to sell off. And again, these are all retrospective shorts we had. And again, that's only the Dow Jones. A lot of people only jumped into the S&P 500, but again, similar sort of short, 2843. All I'm trying to do is talk you through the shifts in sentiment. Now, right now, it is still exceptionally bullish. There is a lot of complacency still in the market. But if we do see this pullback, again, fear is going to continue to sort of spike, or at least it's going to become elevated. You're going to see the volatility index begin to rise, and then a lot of people naturally are going to begin talking about, I don't know, the uncertainty around the proposed trade deal with China. It could be impeachment. I don't know what the talking sort of heads are going to sort of link the sell-off to in regard to the equity markets. But this is going to be another opportunity, as it was over in the back of December and early in the month of January, to actually position yourself long in the market for price action to ultimately take out the all-time high. So think about this as one of those final opportunities to enter into the market, long-term push positions or trades out as much as you can into the future if you're an options trader. Otherwise, be prepared to hold this market once you get in at lower prices, and you'll be rewarded come further into 2019, especially once that pressure cooker explodes, once we break above the all-time highs across the board for all of these equity markets as well. So that's going to do us as at this Monday afternoon market recap. I mean, I think you understand why I haven't been on the public forum here on YouTube for that long. Again, not much has changed. This market is trying to push on up higher, but as overbought and overextended as what it is, naturally, you have to be prepared for the pullback. And that's essentially what we've been speaking about a lot over the past couple of weeks in that pro analysis class each and every Saturday. Have a look into it if you're interested into analysis or understanding market movements. Other than that, everybody, enjoy your Monday evening. I'll be back with you later in the week for some more market updates. All the best. Farewell.